everything in life has risk.
Mm-hmm.
The more risk you have, the more payout you want. The more payout they want means that rates have to go higher so people will buy the rates, which means Chicago and the government have to pay out more interest, more, because people don't want to own the bond. They have to basically beg people to invest. This is the same thing in multi-units. The rate of return in Lincoln Park is lower than the rate of return in other areas that are not as affluent, because people don't know if people are going to rent those places. So they need risk premium. So what Chris is talking about is risk premium. That's why the bonds keep going higher, because they don't trust the people that are issuing the bonds.
What's the 5 Ps? Do you remember it?
Proper preparation prevents poor performance.
There you go. It doesn't matter how much money we get. If we don't close, it's no money, right? So no close is no money. I'm everything that I am because of my dad's death. And I wouldn't be as successful without his death.
All right, welcome to the second podcast of 2025. We just finished up the roundup. And this one is, we're going to go over them here with Chris Delaney. Chris, give us a little, returning guest, give us a little bio, and let's get into it.
Yeah. Do I get like a special jacket for the 3-timer club?
Are you 3-timer?
Yeah.
Oh,
I think
Jesus.
So.
You're like Steve Martin in the Saturday Night Live.
I am president and co-owner of Reside Home Loans, local mortgage brokerage. I have 2 other business partners. We worked together for 10 plus years at a prior company, decided to open our own shop. So we're coming up on a year of that. We have 4 employees now. So we just hired another processor. So, you know, when the February jobs report comes out for January, one of those jobs will be from us.
Man, you're doing your part.
Yeah. So, but no, it's been good.
You're adding to inflation.
Yeah, well, considering that we don't really have like a physical product to sell, but no, it's been great. It was a really good year, pretty much in line with what our projections were for production and everything. But we decided to bring on another person just to kind of help manage the flow a little bit more, and also so we could expand a little bit.
Nice.
So
we'll finish. When we finish, I've decided, so I listened to Tool all this morning. Mm-hmm. I still have a little bit of pre-workout in me. I did a cold plunge, and I literally, when I was in the sauna, I just went through like 400 rants in my head. We're going to go into them. I'm going to rant today at the end of this to the point where Chris may get embarrassed, but there's just a couple things I want to go on. But first and foremost, obviously the market has started really early.
Yes.
And I attribute that to, I think like last year, everyone losing out. Everyone, for the first time, I had so many buyers say to me, I don't want to be like in the thick of it in late February and March. I don't want to be dealing with X, Y, and Z. Let's get out. Obviously the weather sucks. This weekend it'll get down to like 7, but the weather's been mild, which I also think helps too. But we're already seeing multiple offers, and everyone wants to know, rates. Like, obviously that's such a huge part of it. They're not going down. What do you think will help these rates come down on the long term?
That's a pretty big question. Well, I think right now, as it pertains to rates, especially the bond market, there's a lot of sentiment built in. And what I mean by that is, so let's just look at the 10-year and let's look at inflation, right? So go back, to when inflation was 9% and where yields were, right? And then go to today where inflation's at and where yields are. So there's clearly a detachment, and it's not necessarily in line with fundamentals, which would be based on actual inflation, GDP, and everything else. And I think the fundamentals would probably say that the 10-year, for instance, should be closer to 3.5, somewhere around there. And
the 10-year spread between that and where the 30-year rate that people know, What's the spread on that? So if we're at 3.5, where should rates should be at?
Well, historically, it's changed a little bit, but usually that 2% range is usually the distance, right?
So we should be at 6 or a tad under.
Yeah, well, I'd say it's about 2.5 right now.
Okay.
But, it has varied anywhere from down to 1.5 in terms of the spread up to 2.5. And I think even, especially like fall of 2023, I think that gap was much wider than that. So it has come in line. But, just looking at rates and, again, where inflation's at, there's definitely a sentiment that's in there, right? So speculation. Sometimes they call them bond vigilantes.
Okay.
Who are just out there consistently shorting the market. And of course, you're going to have hedge funds shorting the bond market too, because rates are going up. And as rates go up, they just keep shorting more, and it can be a little bit of a spiral. But getting back to answer your question.
So what is that speculation? So like when you're saying, what are they speculating?
So I think it's so there's a kind of a buzz term that I've heard thrown around lately, term premium.
Okay.
Right? Which my understanding is doesn't really mean anything. It's just a way to describe something that doesn't meet the fundamentals. And so this term premium is essentially looked at as this is what investors need in order for them to take on the risk of these bonds right now.
That's what I want to get into. So I'm glad you said that, because that was one of my rants. So
there we go.
I think what Chris is saying and what people really need to understand is that everything in life has risk. Mm-hmm. The more risk you have, the more payout you want. As the U.S. government, and this will lead into Chicago too, as Chicago is, as they have more risk in terms of what people think are going to happen to the U.S. government or Chicago, the more payout they want. The more payout they want means that rates have to go higher, so people will buy the rates. This is like when yesterday Chicago got Moody downgraded our bonds. That means, hey, Moody's saying, we're not buying bonds. This is a fictitious number. We're not buying Chicago bonds at 4% because there's too much risk.
Yeah.
We need them to be at 4.5 or 5, which means Chicago and the government have to pay out more interest, more, because people don't want to own the bond. They have to basically beg people to invest. This is the same thing in multi-units. The rate of return in Lincoln Park is lower than the rate of return in other areas that are not as affluent, because people don't know if people are going to rent those places. So they need risk premium. So what Chris is talking about is risk premium. That's why the bonds keep going higher, because they don't trust the people that are issuing the bonds.
Well, and it can that, and then also you could potentially get into this death spiral scenario when you talk about government bonds and government spending, in that they just have to keep borrowing and issuing these bonds, and that drives rates up, and nobody's buying these bonds, and it can almost end up being a death spiral where rates just continue to climb. I don't think we're in an environment where we're going to see rates spike. If I had to give my best estimate, I would say, and this is probably a pretty safe prediction, that will be somewhere probably between 6 and 7%.
Which is like historically fantastic.
Yeah. Well, I always, I posted a meme about it, I think this summer, and it was like, the Squid Games guy, where he's looking all sad and then he's happy, and one of it's like 6.5 in 2022 when he's sad, and then 6.5 2024. It's all about perspective,
and I think that's why we're so busy.
Yeah.
People are like, "Fuck it, this is where we're at, man."
I have said this for a very long time. Of course, rates are going to influence some buyers, right? But the people that are actively buying, it's that time in their life. They want to make that move. Rates aren't the problem.
No.
It's the inventory.
100%.
A lot of the people that have started to come out of the woodwork at this time of the year, especially for me, have been people last year that put 5, 6, 7 offers on places and lost out multiple offers, and you get exhausted from that, and you just say
it's demoralizing.
I'm going to rent for another year.
Yeah. And then they're like, that's right. That's where everyone, like, I got calls in December. Like, we're not going through what we went through last year. Mm-hmm. They're like, our rent's done in April. We'll buy in January. We'll close in as far out as we can. And if we have to eat months, we'd rather do that than pay $50,000 over asking because we're in the herds in March.
Mm-hmm. Mm-hmm. Well, especially if they're in the suburbs, because the single family market out there is just
it's nuts out there,
it's
dude.
Insane. Yeah,
it's nuts. I mean, I don't like people always say I'm going to move to the burbs because it's cheaper. I'm like, it's not. It just isn't. I mean, unless you want to go west of Naperville.
Yeah, there's some suburbs that I wouldn't necessarily say are going to be cheaper, that you may not have as high of taxes as you're going to have in Oak Park or Naperville or some of those suburbs. But everybody that's making that move in their life is thinking about the burbs and single family homes out there.
I just think a lot, like when I go up with people, like I'll have people that are say, hey, listen, let's look at this, and then let's also do Arlington Heights, Glenview,
Mm-hmm.
let's do Wheaton, this and this. And, I mean, the base price in Glenview is 1.2 and up. Mm-hmm. At Arlington, we couldn't find anything under $1 million. Wheaton's coming. I mean, like, it's just like, what you thought, like, hey, I'm gonna go there and get a nice house for $600,000. That's done.
Yeah.
That's done.
Well, and when you get up into those price points, I think the somewhat surprising thing is the increase in the level of cash offers that you'll see. So I have a client that's looking in Winnetka up to 1.5.
Winnetka 1.5? They're willing to give up a child?
They just had a kid.
Are they offering it?
Well, so we had kind of a call, the clients and their agent, and she was explaining to them, 40% of offers up here are cash.
Oh, yeah.
So, I mean, and that's, I would say, where are people coming up with this disposable cash?
So you would think that, but like, think if you were in your mid-20s in 2015 and you just started saving, and then all of a sudden the S&P went up 300%.
Well, and that's one of the things I told them was, a lot of this is people borrowing against their assets.
So it's not really cash, right? They'll borrow off their assets, and then they'll just for leverage to get the place, which is smart, and then they'll refi out of that to a normal loan.
I mean, what idiot has $1.5 million sitting in a savings account? I mean, the FDIC is only insured $250 of that. So
it's really interesting. Every time it's a cash offer, when I get one, they just print out their stocks, and my person's like, "What's this?" I'm like, "They're just going to borrow against it."
Yeah.
I'm like, it's the smartest thing to do. The rate's not bad, and listen, like in Winnetka at 1.5, that's a war. That's like people are probably knifing each other. Mm-hmm. That's a tough price point, really, anywhere.
It's going to be interesting. I'm hopeful for them. Great people, so I think they'll end up landing on something.
I mean, as long as they don't need air and heat.
Well, luckily they own that. They have a nice place right now in the city, and they don't have to do contingent or anything. So
that'll work out.
They've got time.
We got time,
and they're under no delusions that this may not happen in the next couple months, and it could go into the summer or even the fall.
Until the fall.
Yeah.
So I had lunch yesterday with a really good friend of mine and my financial advisor, and we kind of had the same conversation about the rates. And I was like, I could see rates drop by a full point by someone just saying, a couple things. There's a couple bills on the table in Congress that are going to be brought to Congress I think could lower rates just from showing that they're going to get this under wraps.
Curb spending.
Yeah. So everyone knows that Congress is the one that spends money. So if there's going to be change, it's going to happen from Congress. And this speculation that Chris is talking about is exactly it. They just can't see. They can't see the U.S. government stop spending. They can't see, and the same thing in Chicago, stop spending. So the two big things, right, is term limits, which is going to hit the floor soon. I think I'm dying to see which Congress people won't limit their power.
Probably the people that are near death.
Yeah. So like I would tell everyone out there, and no matter if you're a left or right, if your congressman does not sign that they're willing to cap limits in the future, term limits, do not vote for that person, because that means they're power hungry. And the reason they don't want to get out is that they're making so much money in Congress. Because the original people that were in government in the 1700s and 1800s, they had to leave because it was free and they had to go make money. So it was people that were giving their time up and not being paid. So that'll be, and then the other one will be single stock trades.
Oh yeah.
Those two things alone, I think that would send a shockwave, and I think people would be like, oh, hold up, there's going to be a change. And if you get those two things signed, I think you have like a half a point right off that, because that'll pull that risk speculation out of there. It'll bring
I could see that. Yeah.
That's what I talked about yesterday. And then I said, and the second thing is, the minute Doge or anyone else says, we're going to start cutting spending here, here, and here, and start sending that stuff to Congress, and you start seeing, you don't need to have the actual spending stop for the speculators to say, oh shit, now here's what happens too. What happens when everyone's caught on the wrong way? So being a trader for years, the biggest movements happen when people are caught short or long.
Sure.
That's a squeeze. If you got all of these hedge funds in one direction, the squeeze is going to be out of control.
I mean, well, we've seen it before.
Yeah. So like the 2.5 that we have now, the squeeze that we have one way, you're going to get the other way. And there is the market moves like nothing you've ever seen when everyone is on the same side, because there is no one to take that trade on the other side, and it is a vacuum. Yeah. And it's the worst feeling when you're in that. It's like a vomit-inducing feeling. But I think that's what's going to happen. I think we just need a rumor. We just need something that says, not rumor's the wrong word. We just need some sort of action that says, hey, you know what? We know we've let things get out of control.
You think they're going to admit that, though?
They can admit it. No, they're not going to admit it. But what they can do is say, hey, listen, single stock trades, which have bipartisan, term limits has bipartisan, those two things have bipartisan. If those two things happen, you start taking money, special interest out of Congress. Yeah. When you do that, the spending drops. Because special interest just wants you to spend money. I don't think that's that far-fetched to say even if it brings to the floor, I think that's what's going to be the catalyst, and then I think we're going to have people caught the wrong way, and you're going to have overselling, and when the bonds overbuying, like you're going to have this
risk off stocks, risk on bonds.
Yeah, you're going to have this thing where like, oh my God, we're on the wrong way. They're doing this. Yeah, and it only takes, like, what are we? I'm going to forget the number, but I think we're 35, 36, 37 trillion.
Yeah, it changes. It goes up every day.
Yeah. So I think, you sit and you say, okay, we're at 7.5 trillion, which was supposed to be, let's just say they go and they say, we bring in 5 trillion in receipts, and instead of spending 7.5, this package is 5.5 trillion. If you can get us close to par, I think you're going to get sixes. I think it's going to be like this. And I think it's going to go that way. I think we're going to go like this.
And I think the spending is it's a tough conversation as a nation, right? Because the way I look at it is, if we don't get spending because all we've done for decades is kick the can down the road, and it just keeps snowballing. If we don't get it under control, we'll never truly tame inflation. And all the other stuff, the social stuff, none of that will matter when people can't afford their basic necessities.
That is and that was what another thought I had. It's like, we all want to take care of everything, right? I get it. But we can't save a bird if we can't feed our people. Yeah. Like, we need to contract, get everything together. Like, listen, the last couple of years have been hard for everybody. I look at yesterday, I printed out my Chase bill, and I'm like, what can I eliminate? Now, would I love to have 7 different movie channels and this and this and this? I'm like, yeah. But when eggs are $9
and your kids
carton,
are eating
and my kids eat them
a day.
Yeah, it's like I have to. Okay, do I want Netflix?
Yeah.
Or do I want eggs?
Yeah.
And that's what the government has to do. That's what Chicago has to do. That's what everybody has to do. We have to say, what are the necessities? Let's get that under control. You know, I'm like, I love people listen to my podcast, but I will tell you the number one podcast that anyone should listen to is the All In podcast.
Okay.
It's amazing. They're all VC guys. It's completely data driven. It's a completely data driven podcast. And you can't argue with the podcast because it's just data, you know, like,
sure.
Like you can say you have an opinion, but this is the truth. And they brought up, it went viral, but they brought up Chicago, and they're like 80% of Chicago's money goes straight to pension debt from years ago. And 80% of our taxes only attack 25% of the pension debt. So the pension debt, and that's the same thing. Now we make $5 trillion in America. $1 trillion goes to the debt, just the interest, not even the debt, just the interest. How are you going to take care of homeless? How are you going to take care of all these other things if you can't get your act together there? And the reason I'm saying this, because all of this that we're talking about is why rates don't go down. They've cut rates 3 or 4 times.
I mean, 3 cuts, but I guess technically if you're going to count every 25 basis points as a cut, it's been 4.
So they've cut a full point on the overnight, and rates have jumped a full point. The people that are willing to really put their money where their mouth is don't believe in what we're doing. That's it.
Yeah.
It's a complete and utter, like, it's not an opinion. This is fact. 1 + 1 = 2. If rates were dropping, people would be like, we believe that the U.S. economy is doing well. It's not. That's why rates go up.
But that's what the reports say.
That the U.S. economy is doing well?
That it's doing well.
Well,
right?
yeah, we have 7% deficit spending.
The NFP, unemployment, just ticked down a little bit, but I mean, we could get into this.
Yeah, but let's pull out government spending. The economy is contracting at 3%. We are in a tailspin if you pull out government spending, and the government spending is deficit spending. It's just we're taking a credit card and being like, all right, this Discover's maxed out. Let me apply for a Visa. I'm going to pay the Discover interest with the Visa, and then cap out the Visa, and then get an Amex and pay. Like, you can and we have no one that's like, at least Visa will be like, hey, I'm not giving you another card.
Right.
No one is the people that print the money spend the money. This is like, it's insane.
Well, and to that point, you think like, okay, family dynamics, right? Family budget. At some point, the consumer, the family's tapped out, and they've got to stop. They've got to stop spending. They've got to start making cuts. The government doesn't have that problem.
No, they just print more money, which is a huge tax on all of us, because every time they print money, our money's worth less, right? So like, oh, let's just deflate the dollar so we have more money. Like, I don't understand how these are not opinions. This is fact. I don't understand how people don't look at this and say, we have to stop spending money. And I always bring up the family thing with people. I'm like, listen, we all live in a house. At some point, there's no more money.
Yeah.
There just isn't. And you have to make choices. Sell a car. Don't go out to eat. Sell your house and buy a house that you can afford. Like, these are just, and no one wants to make these choices. They're not happy choices. But if you don't make it, you're screwed.
Yeah.
I mean, we're living in a society where all of us have to be held accountable, and the people that are providing for, are supposedly providing for us are not held accountable. It's such bullshit.
Well, and again, to your point, the more they spend, the more it harms us in terms of inflation, which we don't really get much of a say in. And I think it was Milton Friedman that said nothing will destroy a society more than inflation.
Every major, I will tell you too, like, every major war every major revolution starts with inflation.
Sure.
As soon as you can't buy bread.
Yeah.
Right? Like as soon as you can't afford to as soon as the people cannot afford to feed themselves, that's when revolution starts.
And that's what I, go back to what I was saying about if we don't get it under control, all the other social issues they won't matter.
They don't.
None of it will matter.
Because you can't have money for it.
Right.
I mean, it's unbelievable. All right, so that actually embodied a couple of my rants too. I'm just like, I just can't understand, like, and everyone, every time like last night, I was at the Bulls game with a friend, and he's like, where are rates going? How's the market? This and this, and I'm like, listen, the market's fantastic. I'm like, because there's no inventory, right? You got 10 homes. There's 100 people that can afford those 10 homes. That's just the, we need 110 homes and 100 buyers. Then you're going to have price pullback.
Right. Some deflation.
Yeah.
Price, yeah.
Like we were talking yesterday too, we need deflation. And I was, I'll get your thoughts on this. I had we're negotiating an offer right now, and they're like, we don't know what's going to happen to the economy, this and this. And I was like, listen, here's my 2 cents. I said, at some point, we're gonna be in a deflationary environment where everything has to kind of come down and pop. I said, but at that point, the U.S. dollar should start to get stronger. And I said, would you rather have a 1.4 house that goes to 1.8 and have eggs go from $6 to $20? Or would you rather have a one house and have eggs go from $6 to $1.50? Mm-hmm. I said, the second one, you've made a lot of money. I'm like, don't look at the print. Look at what you can buy. And I don't know if people have the wherewithal to understand that.
People tend to have a very short-term view, right? So going from 1.4 to 1.8 or the other direction over time, I mean, if you have a home in that value, yeah, that's a big swing, but you're likely in that home for a long time. Right, so you're going to have the fluctuation in price, but to your point, I mean the cost of the goods that you buy every day are really what matters. You're not looking every day, what's the value of my home? What's the value of my home? You're not looking at that when you make that monthly payment. That's probably on a fixed rate. That you're making that same payment every month. That's more of what you're thinking about rather than is the value of my home going up substantially or not. I mean, it's great over time. But I think the necessities are what is more important and what you're paying for on a daily basis.
Yeah, because when the dollar gets stronger, the price of your house is going to fall, but it's falling. But the power of that house when you sell it, the buying power is more. Mm-hmm. And I always tell that to people. I'm like, that's what's great about getting in the market whenever you want. And I know people say that, but financially, you just get in because. If we do get into a situation where rates start to drop, you can just refinance. You're locked into that dollar amount.
Right.
But if you get into an inflationary amount and all of a sudden everything starts to go higher and higher and higher, that house is worth less and less and less if you don't have it locked in because that dollar is getting worthless. So I just think that a lot of times people are hesitant in terms of where the prices are going to go. I agree with you, but what's more important is what it costs to live on a daily basis, and that's the strength of the dollar. And the dollar will continue to get stronger as we stop spending it and we stop printing it and we start pulling these dollars out of the market. That's the one thing we have to do. We have to pull the dollars out of the market. When they raise rates, what they're trying to do is pull dollars out of the market and make the dollar stronger. The problem is when you have a lagging economy and rates go higher and you're in stagflation, then we look at the 70s, and then that's a problem.
Yeah, well, I would say to that, we always have to be careful using the past to predict the future. But certainly there are some similarities in the situation, but much different circumstances. I mean, our main issue here was massive stimulus, no production, and we're still dealing with the ramifications of that.
Yeah. I was also thinking about, obviously your son is at Lane Tech and my son will be going there soon. And that was a vocational school. And I always think about that, like 2 days ago, the print was, another loan forgiveness program. They're trying to sidestep the Supreme Court and try to figure it out. And I'm like, instead of giving stimulus to someone that, majored in humanities and great books and spent $200,000 on that and decided to, do whatever. And I was like, why don't, come on, let's call it how it is. Why don't we take that money? Why isn't junior college free? Why isn't vocational school free? Like, why aren't we building like electrical, like places people can go and learn how to be electricians and plumbers? Let me tell you something. My electrician, my plumber, my HVAC guy, they all make about $500,000 a year. They work 2 seasons and then they go and do things the rest of the time.
A South Park episode about that.
But it's the truth.
Yeah.
I'm always like, Jack, my roofer, where are you? Oh, I'm in Europe. I'll be back in 3 months. He doesn't work the winters, and like, I just don't understand, like, why should we be giving money to people that made mistakes versus giving money to people that are going to enter the workforce and have a talent, right? A talent.
A skill.
Yes.
A skill that is needed. So I talk about this with my son all the time. He, some time back, he was saying, I think I want to like learn to code and maybe, I'll be a coder. And I'm like, listen, number one, everybody's learning to code right now. Number two, AI is going to probably crush that field. And I was like, if you go into coding and you go out to get a job and it's a saturated market with potential employees, that drops your value, right? So it's you can look at that in supply demand dynamics. So yeah, you get these goofy degrees. Of course, you're not going to go out there and make a substantial amount of money unless you figure out a way to, start a business or something like that, which most people that start businesses don't have degrees.
It was really interesting you say that because this morning we were talking about mechanical engineering and stuff like that, and like different types of engineering that won't be replaced, like stuff that you really need. And I just, like, I was talking to Lee and my wife, and I'm like, you just need to get a job where a robot can't replace you. I mean, Elon said it yesterday. He's like, we're going to roll out X amount of robots. He goes, in 26, it'll be 10X. 10X. I mean, the guys on the All In were talking about the robots 2 episodes ago. He's like, yeah, I just bought 3,000 robots for $1,600 a piece. I put them out on my properties, and they walk the properties, they collect data, and they tell me how things are going. They have automatic drones that go over. I'm like, you have to make sure whatever you're doing, you're making the robots, and the robots isn't going to do what you do. And it's sales. There'll always be salespeople. Always. There's always going to be a human connection. Because I mean, like, look at like people like obviously you do your, like, now you do online. You do, hey, I'm gonna do my application.
Yeah.
But it's still talking to Chris.
Yeah.
Like G-Rate's like, oh, you don't have to talk to anybody, right? That was their whole thing. It's gonna be everything's automated. No, dude. This is a fucking convoluted process. You need somebody there. That to me is robot proof. Sales are robot proof.
You can get into underwriting that's AI, and I'm sure in some industries they're using that. And I'm sure it will probably get to that point in the mortgage space, but there's a lot of red tape and risk that.
But you have to evaluate the person.
Sure.
And what that person's dreams are, what that person wants to be.
Well, yeah.
There's always going to be that space. Like, I always say that to everyone's like, oh, real estate, they're going to do this. I'm like, no, you can't. I said, you can't do valuations. Ask Zestimate. It almost destroyed Zillow when they were buying all these homes and trying to figure out what the values were. Like, no, it's never going to happen because each street is different, right? Each loan application person has a different tolerance for risk, different outlook, what they're using the place for, when they're going to move again. That data, that personal data, that feeling. I mean, until we start tapping into people's brains, and maybe that happens, but we'll be dead by then. So I don't really care.
Not our problem.
It's not my problem. But I still think there's all that. And it's like, why don't we spend the money on educating people? Like, listen, not everybody's going to be a doctor. Not every person's going to be to college, right? I think only 10 or 15% of America should be in college, period, as it is. The rest should be learning a vocation. And then you're driving down prices. You're driving down inflation, and then on top you're going to get lower rates.
Sure, yeah.
I just don't understand why there's not an emphasis on that. The emphasis is let's hand out money to people that made bad decisions, right? And then, the person that's a handyman, the person that does do the HVAC, the person that did go to vocational school, they're paying for that money. Like anytime, I love when they say the government did this. I wish they just replace it. You did this.
Yeah.
American people, you're paying for this. Why don't we just say that?
I mean, you could look at, especially like college tuition, you could potentially look at that. And I think there's actually a theory, and I don't remember the name of it, that is connected to the substantial increase in college tuition and the availability of government loans for those, right? Because those loans, there's like no criteria. I mean, 18-year-old kids getting loans for tens of thousands of dollars. There's a theory that's led to, a substantial increase in college tuition. And, these colleges are marketing to these kids. I mean, you probably get them too. You get 1,000 things in the mail.
Oh my God. Every day.
It's
such a business. And if they just had less people now college admissions and people going to college is dropping rapidly.
Makes sense.
Which makes sense. And I just think that's people saying, oh, I don't need to do this. Let me do X, Y, Z. I think that's the advent of the phone and people growing their businesses. So, I think that's good. But just like the money supply that's out there, that needs to drop, which then you have less defaults on these loans. So these schools, how does a school go from, how does Notre Dame go from 30,000 to 90,000?
Yeah.
90,000. You got to have a school.
Easy
you got to
loans.
you got to have that are not payable.
Yeah.
So someone has to pay that, and who's paying it are the people the other students that can't pay.
The school's getting their money.
Oh yeah, because it's Gary. Yeah.
Uncle Sam's not the one that's getting paid back.
$400,000 to come out of Notre Dame or any other of these institutions.
You can't file bankruptcy on them, and yeah.
So what is like? Let's talk about issues you have with people that have huge debt coming out of college that are trying to buy a home.
I wouldn't say I have a lot of issues.
How does the banks look at that debt?
Well, so there's a couple ways. Number one is what's the payment that's reporting on the credit report, right? Oftentimes that may be lower than what the payment actually is, right? So we go off that. If there's no payment, let's say.
Now, how is it lower than what the payment actually is?
It's just whatever's reporting to the credit report. I mean, I've had borrowers say, I think I'm paying a little bit more than that, but it's what's on the credit report because that's what they're reporting to the creditors.
But how does that happen?
I don't know. Sometimes I think there's a detachment from what borrowers think they're paying and what they're actually paying. They may be paying a little bit more every month and not realizing it. Like I've had that happen with people with mortgages where somehow they started paying more and they totally forgot about it and they didn't realize I'm paying an extra $1,000 a month.
Who you slap them?
It was a good buddy of mine. You actually met him. Good buddy of mine. I called him to tell him to call the bank and get the PMI terminated. And he was like, I've been paying an extra $500 a month. And I'm like, why were you doing that? He's like, I didn't even know I was doing it.
Oh, there's got to be something. All right.
But anyways, there's a couple of ways. So we can go off the credit report. That's probably 90% of them, especially now that we're out of COVID forbearance and all that stuff. If they're deferred, they're in forbearance, then it's anywhere from 1% to 0.5% of the balance that you qualify them on. And then there's also the option of, okay, payments are really high. Are you on an income-based repayment plan? Because often those are much, much lower. Especially for conventional loans, you can go off that, which is very helpful. If they're a physician, resident, something like that, then there's a little bit more flexibility if you use a physician loan product in terms of how they'll calculate those student loans. But I wouldn't say I have run into a situation where, in recent memory, where somebody couldn't qualify because of their student loans. I have a lot of people that call me. Initially, they're worried about it. And then we get into it, and it's fine.
It's fine.
Yeah. I mean, I had a lady that I was working on a pre-approval for, I think maybe back in June. And I don't think we did I think we just did a soft credit pull at that point in time, which those are always kind of a little funky. Sometimes the student loans come across a little messed up. But she had all these student loans, and I'm talking to her about it, and the way that I'm looking at it is, it looks like half of these were just transferred. And she's like, no, they weren't transferred. And it was just too much for her to qualify. And that was at the time that the student loan forgiveness was still on the table. So she was waiting to find out about that. So we tabled it for a little bit. We got back in touch maybe in like September or October to try again. And I re-pull credit. And sure enough, that one half is completely gone. And I told her, I'm like, this is what I thought happened, was that the loans got transferred. And if we could have just, if you would have looked into that and we could have documented it.
Oh, so they were showing a double payment.
Right. Because it was in the midst of being transferred.
Got
right?
you.
So it's still, the old one's still reporting. And I can kind of tell when I look at that stuff because a lot of the balances are similar. They're not exactly the same, but I'm like,
this is close enough where there's some funkiness.
Because, when we look at a credit report for student loans, it's not just the one total, right? There's going to be 10, 12, 13, 15 different student loans. They're all broken out. And so when I see that, I suggested that she check on it and let me know, and she swore up and down they weren't transferred. And then sure enough, when we reran credit a few months later,
listen to Chris. Listen to Chris.
I mean, I've seen enough credit reports.
Yeah.
I don't profess to be a credit expert, but I've seen enough credit reports that I kind of know what's going on,
What else is happening in terms of giving people ability to purchase that's changed? You see changing in 25? Any rumors in terms of people like, hey, this is going to be changing, this is going to be changing?
No.
We always have different limits in FHA. How about, I have a question for you. How about the sustainability in FHA for multi-unit buyers?
For 3 to 4 units, I haven't heard any changes in that.
Okay.
I mean, it's never been a thing on 2 units.
Okay.
3 and 4 units it is. And that's an incredibly difficult thing to pass in a rate environment.
That's impossible.
I've had it pass once, and it was like a 2.5% rate. This was years ago, and he bought out the upfront PMI instead of financing it, and it worked. So I tell everybody, I always like to set expectations and be honest.
Can you explain that sustainability for people that are looking at multi-units?
So for
and it's only for 3 units. I didn't know that.
3 and 4.
Okay, 3 and 4.
So it doesn't apply to 2 units. So essentially, FHA wants to know, if you lose your job, can the building maintain itself on the income that it brings in? So they look at the rents for the building. They take out a 25% vacancy factor, and
they don't look at they don't look at vacancies in those, like, it's 25%. Nothing is vacant in Chicago for 25%. They don't make adjustments. It's like, that's national. It is what it is.
Maybe we could write to HUD and make the case.
But I'm just saying, that's a lot, a fourth of the year.
The 25% vacancy factor is also not that there's a sustainability requirement for conventional, but if we're like renting out a departing residence, they'll give you 75% of that lease.
So it doesn't, that's just what they do.
So it's just kind of a standard across the board. So the sustainability test, the rents at 75% need to cover the total monthly payment, including taxes and insurance. And it's just, there's not a situation where you're either going to find a property that's priced low enough that the rents are high enough, or vice versa. I just never ran into it because rates were never that high. Mm-hmm. And we were looking at 3 units. We're like, oh, this is perfect. And they're like, oh, and this guy's like, listen, he's like, it doesn't fit sustainability. And I'm like, what's that? And he's like, all the units have to be able, they have to be able to sustain with, and I was like, well, I literally said to him, I looked at my client and I go, I don't think that's possible. No.
I'm like, you would need a cap rate of like 13 or 14%.
And it helps now that, especially because FHA is only for primary, that conventional dropped that requirement down to 5% from 15 for Fannie Mae. That was 2 units.
Hold up, say that again. So
if you're buying a 2 to 4 unit conventional financing, you can do 5% down.
Okay.
Used to be 15% down for a 2 unit.
Oh, so you can stay away from FHA because
20% down if you went Freddie. Freddie has not followed suit yet, and it's been, I think we just passed 2 years on that requirement.
So conventional, 2 to 4 units,
yeah.
You can put 5% down. Correct. If you're owner-occ, and there's no sustainability.
No sustainability.
Okay, then what's the point of FHA at that point? Then is it a little bit of a lower rate?
Yeah, but
DTIs.
DTI is a little bit more flexible, 1.5% difference in the down payment, which isn't a whole lot when you think about it. There's also lower loan limits on FHA, but with conventional, you need 6 months of reserves, right? Which could be a non-liquid retirement account, investment account, something like that. If you've got, overall, obviously, you're going to probably have a little less deferred maintenance issues with conventional loans than you are FHA, because as a lot of people know, with government financing, they are a little more picky on deferred maintenance. Yeah. Now, that's not to say that a conventional loan, an appraiser or an underwriter, if they see it in the pictures, will not call something out, right? I've had peeling paint come up on a conventional loan before because the building was older than 1978, right? So it's potentially still a concern, but a lot less on conventional. Other than that, I would say the big thing with FHA is much more lenient on lower credit scores.
Okay.
So that's where it comes into play more. Sometimes there's a little bit of flexibility on DTI. I think, though, really, and what I tell every client, because I get a lot of people, especially first-time buyers, like, I heard about FHA and conventional. And I said, here's the deal. It mostly is going to come down to credit. If you have a pretty good score, I'd say generally 680, 700 or
I was going to ask you for a number. Okay, so 680 or above.
We're primarily probably going to go conventional, right? Okay. Below that, we probably want to look at FHA, and there's a couple of reasons. Yes, the rates on FHA loans tend to be lower than conventional loans. And people look at that and they think, that's great, but FHA has upfront mortgage insurance that typically is finance the loan, or you can pay it outright. Will
the 5% conventional not have that?
You'll have monthly PMI. You'll have that with FHA too, but you don't have upfront.
Okay.
But when you
you mean upfront, like they're going to ask for a year upfront?
So it's 1.75% of the loan amount.
Okay.
Is the upfront mortgage insurance premium that you have to pay on.
Now, is that a dead cost? Like you don't get that back, or is that going into the PMI?
So if you do refinance, you do get a portion of that back.
Okay.
So that is nice, right? Yeah. So if you do like a streamlined refinance, which is just FHA to FHA, it's no appraisal, it's no income, super easy.
How low can you go on? Like, what do you like? Is it you can get 600, 580 on your credit score?
It varies a little bit from lender to lender. So 580 is kind of the lowest for a lot of lenders, and it will vary depending on the times, right? Okay. We get into a situation where liquidity becomes scarce. They're going to tighten the standards.
Yeah,
right?
they can.
Like during COVID, we saw requirements for that go up. So 580 is usually low. So you can go below that. With some lenders, it becomes a little bit of a different ballgame. It's what we call a manual underwrite. You typically have lower debt ratios, sometimes higher down payment requirements, reserve requirements. But what I really wanted to say was, sometimes when you look at FHA payment versus conventional payment, even though the rate's higher on the conventional loan, with the upfront PMI and the monthly PMI that you pay on FHA, even with PMI on a conventional loan, what you'll find is the payments are more or less the same. So yes, of course, the rate on the conventional loan may be a little bit higher, but especially if your credit score is higher, the PMI on conventional loans is tiered in part based on credit score and down payment. So the higher the credit score, the cheaper the PMI. It's for the life of the loan on FHA. If you put down less than 10%, conventional, you got to reach, 80%, you're going to request termination, or it'll terminate automatically at 78% loan to value. And then there's the condo conundrum.
Yeah, doesn't it seem strange to you that the person with the lower credit score gets the lower rate and the person with the higher credit score gets the higher rate?
Well, it's backed by the government.
But isn't conventional also backed by the government?
In a way, yes, I suppose that's correct, but not in the way that HUD collects those premiums, and they basically, that's an insurance premium for the bank if that borrower defaults. So,
who insures that?
On FHA?
Yeah.
HUD. Yeah. And they also use those premiums for, I believe, for reverse mortgages too.
Is that how The Big Short started?
Well, I've got some thoughts on that. But a much different situation than it is today.
Yeah.
So yeah, I mean, there's advantages to doing FHA over conventional, and certainly, then we could get into VA too at some point down the road. But
on the jumbos right now, for people looking for jumbo loans, give us just a little bit of a talking in terms of what's the best product out there. If you're buying a 1.5 house or a $2 million home, is it good to have is it good to only put 20% down? Don't go more because you're really not getting anything for that. If you have the means to make monthly payments, what's your I'm coming to you, I want to buy a $2 million home. You're like, and I have good credit scores, over 760. I can afford the down payment, or I can let it go to a monthly payment. What is your suggestion to me?
Well, I would say at that price point, you probably want to hit 20% down, maybe even 25%.
Okay, and the difference between 20 and 25 right now, is it a rate difference?
Well, it also, when you start getting into that space, especially as you get above $1 million, and then 1.25 and 1.5, you're going to find that the options begin to shrink in terms of the availability of products, because obviously it's a lot of money, it's a risk. Most of those loans tend to be portfolio, right? So the banks that are holding on to those loans, they want a paper, they want reassurance, and they want to make sure that you've got the ability to repay. And so a lot of times they will require some larger down payment.
Okay. So there's no advantage. You just think that that's what people are going to ask.
Well, it's kind of what I've seen. I mean, certainly, when you go from 80% loan to value to 75% loan to value, traditionally, yes, you are going to see a little bit of a positive bump in terms of interest rate pricing.
Okay.
Right.
You're talking like an eighth or quarter?
I don't know that it would be quite a quarter, maybe an eighth.
Okay.
Truth be told, we do some jumbo stuff, but typically when you get into that price point, you know what people are doing.
Yeah.
So we don't see it a ton. And obviously with loan amounts increasing to, 800,000, you're getting a lot more people in conventional these days. The one thing I do like about the direction that a lot of jumbo lending, at least in our space, has gone is that it more or less is following conventional guidelines now. So we call it, like jumbo AUS, which would be automated underwriting system, which is what Fannie Mae and Freddie Mac use. So you still run it through automated underwriting. It's of course going to tell you it's ineligible because of the loan amount, but it still breaks down everything like Fannie Mae and Freddie Mac would on a conventional loan, right? Okay. So what that often ends up meaning is that, usually with jumbo, you're capped at about 43% DTI. Now some of these products should be able to go up to about 50%, which obviously you don't want to see somebody doing that. But the situations where that happens is a lot of times they've got a place that they own now that they're going to sell afterwards. So having that little extra room helps. There's some decent 30-year products. I would probably personally recommend doing like a 7-year ARM. That's kind of the sweet spot. Decently lower rate. Those rates for us usually change about once a week, which is nice.
Okay.
So there's a little bit more stability in terms of locking those in. But 7 years is kind of the sweet spot, I think, because a lot of these people that are buying homes in that price range are probably going to be there for a long time. But even if they're going to be there for, the rest of their lives, the likelihood that they're going to have that mortgage for long term is probably pretty slim. And even if it gets to the point after 7 years where it's okay, rates never came down, we have to refinance, the money that they've been paying at that lower rate is going to chip away at that equity or chip away at that principal faster. So, and property value likely to increase. So wider loan to value, and maybe puts you in a position to, yes, we're refinancing it maybe into a 30-year at roughly the same rate, or maybe even a little bit higher. Might not be the best situation to spread it out over another 30 years, but if that keeps things relatively equal and puts you in a more secure spot, that's what we can do for now, and then we'll keep an eye on things going forward.
All right, so we're going to end on this. What is the most annoying thing that's bothering you about the city? And it could be, I'll start off so I can
Where do I begin?
I'll put, so my thing is people. So maybe this will make more sense. My most annoying thing, to the point where I may start carrying a switchblade to pop people's tires, Not that I condone violence, but my most annoying thing right now is people that, I think it's food people, that park in the middle of the street with their hazards where no one can get by. And this is the key. There's a parking spot to the right or to the left of them that they could pull into. Right now, that is my number one thing. I hate that more than Brandon Johnson.
Okay, all right. I'll kind of piggyback off that. So you say
that's my number one thing.
You say food delivery people. I will get more specific. Amazon.
Oh yeah,
And the Amazon drivers. And if you're an Amazon driver out there and you're looking to buy a home, give me a call. But like props to the UPS guys. But the Amazon guys will, especially on a one-way street where you got parking on both sides, they will stop in the middle of the road. And I know you're not supposed to, park at the fire hydrant, but the fire hydrant's right there. Or you could park at the end of the street, right? And they always pull that shit,
and they'll stay in the middle of the street, and they won't, like, if there's a spot, if the Amazon people have a spot all the way up the street, but they got to deliver here, they will slowly go up because they don't want to walk, right? And they have that huge cart. Get the hell, like, there was a person like 2 days ago, was an Uber driver who stopped in the middle of the street and stopped the whole street, and the parking spot was literally to the right of them. And it was like 2 or 3 huge spots. I'm behind them. I got out of my car. I walked up. I knocked on his window. And I'm like, bro, there's like 3 spots to the right. Can you just pull over while you're waiting? I go, there's like 7 cars behind us. And it's not like I'm in a rush. It's just like, bro, I mean, like,
There's no
be considerate. You're not in your own world.
Right,
they're like in their own fucking world. It's like, dude, there's other people that are living in this world.
Yeah.
And you can just do little things. But like that to me right now is like, it's like, oh my God.
Well, here's a real quick problem that I have is that every time I go out and drive anywhere, for some reason, all the other people on the road are just idiots and don't know how to drive. I mean, I don't know if anybody else experiences that, but I seem to be the only person in town that knows how to drive.
So like, I'll start, like, my middle one's in the car, and he's like, dude, you just are road raging. And I'm like, but hold up. I'm like, my heartbeat has not moved. I go, I'm just laying, and I don't raise my voice. I'm like, that's an idiot. That's an idiot. That's an idiot. That's an idiot. And he's like, man, control yourself. I'm like, my voice hasn't even changed. I'm just telling you where the idiots are.
You're narrating the
yeah, I'm just like, look at this idiot here. Look at this idiot here. Or how about the people that have their turn signal on and don't know where they're going? And they just slowly have their turn signal.
Or they don't even have their turn signal on, and they're looking for parking, right? And it's
at least hit your fucking hazards, man.
Yeah.
Hit your hazards. There's 17 people here. First off, no one in this society, in the world, should ever be lost. Get a cell phone, put it on Google, Waze, or whatever. The fact that you can't find your street you're turning on, dude, it's 2025.
This seems like this could be a podcast in of itself. Driving in Chicago.
I'm just like, but I don't understand it. I'm like, how do you not know where you're going?
Yeah. It's rough out there on the roads here.
My mom even knows to plug stuff in, and she's in her 80s. My 8-year-old knows how to go to hit the voice box. Go to, I don't know, Target on Elston. Start driving. I mean, it literally, turn in 100 feet. Like, you don't have to slow down 500 feet. It told you it's in 100 feet. I don't know, man. That's like what's on top of mine right now. Like, to the point where when I get out of the car, and I'm not doing it to be mean. I'm doing it because, hey, man, I feel like as a person that's on the road all the time, I feel like I'm obligated to help this situation. I'm not doing it for me. I'm doing it for you.
Yeah.
I'm doing it for Alex. I'm doing it for Lee. I'm doing it for everybody else out there.
A selfless act.
It's a selfless act,
for
man.
the citizens of Chicago.
Yeah, pull over.
Thank you, Jason.
Pull over. There's 5 spots. You can walk 10 feet to take your box. I don't know, man. That was, and the other rants we did within the statements, so it all worked out. But I needed to get the car thing in, because if you do this and you're out there, at some point I'm going to start popping tires. It's going to get there. I'm still okay with it, but I'm close.
You should get like a Mad Max car where you've got like all these.
Oh God, hold up. I've been in the car and I said, man, I just wish I had a beater and I would just run into people. Like literally just slam into them like Mad Max.
How about the people that drive on the shoulder?
Where are the cops?
I don't know.
And they're all baked.
I always think about that meme that's all like the human skeletons, and it's like, white, black, Hispanic, all these different ethnicities and orientations, and then it's like not the Neanderthal skull, but like an ape skull, and it's like, to be whatever stupid thing it is. I always think about that, but it's people who drive on the shoulder.
Yeah, it happens a lot,
and it's dangerous, so.
Oh my Lord! All right, well that's good. Everyone, thank you so much for your time. I hope everyone learned something and then had a chuckle today. And if you do feel our pain on the driving, send us a note. Let us know what is your thing that's ticking you off. Thanks so much. Appreciate your time.
Yeah. Thanks for having me again.
Thank you for episode 2, 2005, and our third. It's our 3rd or 4th season. I can't even remember. But we'll talk to you soon, and download and like. Thanks so much. Bye-bye.